The Magnificent Seven tech stocks make up $14 trillion of market cap and are 1/3 of the S&P 500. These are the most innovative and highest performing stocks out there. So, which ones are a screaming buy? Tune in and find out. All right, the way that I'm going to cover this video is as follows. I'm going to start with the sells, move to the holds, and then finish up with the buys. I've built DCF or discounted cash flow valuations for each of the Mag 7 tech stocks, and I'm really excited to share everything I found with you. All right, first stock, Apple. So pros on Apple. It's the leader in smartphones with worldwide market share of 23%, 392 billion of share repurchases over the last 5 years, funded primarily by cash. It's a cash machine. Cash is projected to 20x in the next 5 years by the end of the model that I've built. But some cons. There's an antitrust lawsuit that was recently announced by the US government. Smartphone monopoly is what they're calling them. Only Mag 7 stock with debt greater than cash by $35 billion. And revenue growth actually declined in 2023 by 3%, major headwinds in China. So I'm invested in Apple, but I wouldn't buy more unless there's a pullback below 150. Apple's a great business. They continue to innovate, but it's a bit dependent on the constant wow factor. My iPhone's something I definitely can't live without. And it's the only Mag 7 tech stock that Warren Buffett is an investor in the company. Yet, I have the rating for Apple as a sell, $167 value, which is about a 9% premium, meaning it's overvalued by about 9%. All right, next we have Amazon. So pros on Amazon, massive push into generative AI, leveraging its rapidly growing cloud business, AWS, big investments in fulfillment technology and infrastructure, 130 billion in 2023. And unlike other tech companies, they're reinvesting more into their business rather than returning to shareholders. They've reinvested $255 billion over the last 5 years and returned only $6 billion to shareholders. So that's a 40x difference. Some cons. Hammered by Rivian. So they had a big investment in Rivian. In 2022, they lost $12.7 billion from that investment. Also, the stock is up 80% in the last year, so it's gotten a little bit ahead of itself. And it has the second lowest EBITDA margin of the Mag 7, only behind Tesla. So like Apple, Amazon's a company I can't imagine not having in my life. I order from Amazon multiple times a week, sometimes multiple times a day. It saves me tons of time, tons of money. It's one of the most innovative companies in the cloud. It generates the most revenues from the cloud out of all the Mag 7 tech stocks. Right now, I think the valuation is a little bit frothy. I have a sell rating on the stock with a current value of $175 per share, which is an 8% premium. Next, we have Meta. It's the only pure play social media company out there to invest in. Also, 3.24 billion daily active users. That's insane. 5-year average revenue growth of 20%. But here are the cons. 98% of revenues come from advertising and primarily from Facebook and Instagram. Reality Labs, which is where they're doing AR and VR, lost $16 billion last year. And Zuck warned it's going to lose even more on a going forward basis. But he's betting heavy on the metaverse, and it's going to take time to bear fruit. So what's the takeaway? It's up 20% since it reported at the end of January. I think it was much more appealing then when it was like right below $400. Zuck mentioned a long-term investment runway with Reality Labs, and he's going all in on virtual reality. So be prepared for a bumpy ride. I think it's going to be good in the long haul, so look for some pullbacks. I have the rating as a hold and a value of $460 per share. It's right about at fair value. If you're enjoying this video, please smash that like button. All right, the next stock that we're going to talk about is Alphabet. So the pros, #1 search engine in the world, big investments in AI in the cloud. R&D for AI in the cloud was $155 billion over the last 5 years and $42 billion last year. Their cloud business has almost 6x'd in the last 5 years. They have net cash of close to $100 billion. That is the highest amongst all the Mag 7 tech stocks. Now, some cons. 77% of the business is advertising. So like Meta, that's a big exposure. Also, there's very heavy competition in the cloud with Amazon and AI with Microsoft. Lastly, despite a mostly service-based business, it has lower margins than Apple, Meta, Microsoft, and Nvidia. So Alphabet has been self-described as an AI-first company since 2016. I'm a big fan of Gemini. If you like ChatGPT, definitely check out Gemini. There's lots of option value with $100 billion of net cash sitting there. So they're in a position to outspend the entire Mag 7. On AI, they're flying below the radar. I do have a position in Google. I got in early 2023, but if it got below 150, I would buy more. Right now, I have the rating as a hold. It's a slight discount, 2.3%. I have the value at $175 a share. Okay, next one, Nvidia. So pros, almost no competition in niche AI chips. It has massive first mover advantage. 5-year average revenue growth of almost 47%. Insane. Margin has expanded 22% in the last 5 years, despite massive growth. But here are some of the cons. The stock has absolutely exploded. It's tripled in the last year. $2.2 trillion market cap. It's the law of large numbers. It's not going to triple from 2.2 trillion to 6.6 trillion. It's also priced for perfection, and growth is predicted to decrease substantially starting in 2025. So Nvidia is not the type of stock we can reasonably build a DCF model on. If you go look at my analysis, you'll see we had to do a 3-year, 5-year average and also look at Wall Street consensus. The stock is absolutely ripped, so it's on everyone's radar. I don't expect similar growth in the stock price in the near future. Ultimately, every single company in the Mag 7 is also developing their own AI chips internally now. So they're trying to become less dependent on Nvidia. I do own a small position in Nvidia, and I see some really solid potential in the next 18 to 24 months. I have a buy rating on the stock with an $11.50 per share value, which is about a 21% discount. All right, next we have Microsoft. So pros on Microsoft, this is the forefront of AI. OpenAI partnership, which is the maker of ChatGPT, they have $100 billion earmarked for an AI supercomputer. They have the second highest EBITDA margin of all the Mag 7, 48%, only behind Nvidia with 57%. They also have the most diversified revenue stream. They don't have some big exposures like Meta and Alphabet do. Now, what are the cons? They're the largest company in the world, 3 trillion market cap, so there's limited growth or upside from there. Windows and devices actually declined 15% in 2023, and because of their size, they're always the target of antitrust lawsuits. Now, I was so impressed by conducting the analysis of Microsoft, I actually bought a small position. I think the valuation is compelling. You're betting on the largest company in the world, flush with cash, betting big on AI. I feel pretty comfortable doing that. I don't mind betting on the largest company in the world. They have a very diversified business. I think it's a solid buy in the low 400s, and I have a value of $520 per share on it, which is about a 21% discount and definitely a buy. And last but not least, the most interesting of the bunch is Tesla. So pros, it is the electric vehicle brand with no close second. There's been significant progress in AI with Tesla as well. Self-driving cars, humanoid robots, super innovative company. So what are the cons? Obviously, there's been recent controversies between the layoffs and Elon Musk's compensation case. The results have underwhelmed analysts. There's fears of Elon Musk always being a little distracted. And Elon Musk has even said they have significant Chinese competition and they will be wiped out without tariffs. That being said, I think they're the best of the bunch. Musk is really the Leonardo da Vinci or Isaac Newton of our lifetime. I wouldn't bet against him. I bought a stake during the pullback. And while this might seem controversial, I think the issues being faced by the company are manageable and temporary. I was able to get some in the high 140s, low 150s, and I'll be very happy over the long haul. It's also the smallest Mag 7 tech stock. It's 50% smaller than the next smallest Mag 7 tech stock, which is Facebook or Meta. So it has a lot more upside potential than all the rest of the companies. I have a buy rating on the stock, a $285 value per share, and a 37.5% discount. So that one has the most upside potential. If you like this video and you want to see the individual models that I built, check out my Mag 7 playlist right here. And if you enjoyed this, please share this with someone who you think will find this valuable. Be relentless.